Every Monday to Friday, this is Peter Lewis's Money Talk.
Money Talk.
Good morning and welcome to Thursday. This is Peter Lewis with Money Talk for the 18th of January 2024. This podcast is sponsored by Surfing Group, which is headquartered in Singapore, and it offers online financial services to 30 million customers across 10 countries. In today's business and finance headlines, the Chinese economy expanded 5.2% year-on-year in the fourth quarter of 2023, faster than 4.9% year-on-year growth in Q3, and slightly below economists' forecasts of 5.3%. Fourth quarter GDP was 1% higher than in the third quarter. And for the full year of 2023, the economy also grew by 5.2%. That exceeds the official government target of around 5% and is picking up from a 3% rise in 2022. China's population decline accelerated in 2023 as deaths rose and births fell for the second year in a row. China's overall population fell by 2.08 million in 2023 to 1.4097 billion. Birth declined by 5.6% to just over 9 million in 2023, but the birth rate was outstripped by 11 million deaths, and demographers forecast further falls as the population rapidly ages. China's property sector, which has been mired in a debt crisis for 3 years, continued to suffer in 2023, the official statistics showed on Wednesday. Investment in property development fell 9.6% year-on-year last year, compared with a year earlier, and accelerating its descent after a 9.1% fall across the first 9 months of 2023. And China's new home prices dropped by 0.4% year-on-year in December, faster than a 0.2% fall in the prior month. It was the 6 straight months of declines in home prices and the steepest pace since March. The European Central Bank is likely to cut rates in the summer, its President Christine Lagarde said on Wednesday, disappointing markets that had been anticipating a first rate cut in March. She added that policymakers should have enough wage data by late spring to decide if Eurozone inflation will keep falling. She said inflation is not where the ECB wants it to be, but she was confident the central bank will get inflation to the 2% target. On today's programme, I'm joined by Andrew Freris, the CEO of Ecognosis Advisory, and Marc Franklin, Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investments. We're also going to talk about Asia's frontier markets with Ruchir Desai of Asia Frontier Capital. And if you want to get in touch, please go to my website, peterlewismoneytalk.substack.com.
Peter Lewis's Money Talk.
Global stocks and bond markets retreated on Wednesday as investors scaled back expectations of swift interest rate cuts in the Eurozone, the UK and the US. The S&P 500 slid 0.6% to close at 4,739. The Dow declined 94 points, that's 1/3%, to close at 37,267 in the third straight day of losses. And the Nasdaq Composite lost 0.6%, ending the session at 14,856. 10-year Treasury yields climbed to a 5-week high after US retail sales rose more than expected in December. The 10-year yield climbed 4 basis points to 4.11%. Yields on rate-sensitive 2-year Treasuries rose 13 basis points to 4.36%. The US dollar index was unchanged at 103.38 after edging up to a 1-month high of 103.5 earlier on Wednesday. The dollar rose 0.7% against the yen to 148.19. The offshore yuan depreciated past 7.22 per US dollar, sinking to its weakest level in nearly 2 months as the greenback rallied. Spot gold traded 1.1% lower at a 1-month low of $2,005 an ounce. Brent crude oil fell 0.5% to $77.88 a barrel, recovering from earlier losses of almost 2%. And Chinese equities plunged following the data release from the mainland. Hong Kong's Hang Seng Index slumped 589 points, that's 3.7%, to an almost 15-month low of 15,277. Every sector was in the red, and the city's benchmark index is down now 10.4% since the start of 2024, and has lost more than half its value since its most recent peak in February 2021. It was dragged lower Wednesday by the Hang Seng Mainland Properties Index, which fell 5.4% to an all-time low following the release of official housing price data for December. The Hang Seng China Enterprises Index, that shed 3.9%. recording its worst day since October 2022 and taking its declines to 11% so far in 2024. That makes it the worst performing major benchmark globally this year and follows 4 straight years of declines. The tech index plunged 5%, taking its fall so far this year to 16.1%. On the mainland, the CSI 300 index of the largest Shanghai and Shenzhen listed stocks fell 2.2% to a 5-year low of 3,229 and taking the 2024 decline to almost 60%. Futures markets pointing to a small rebound for Hong Kong stocks at the open of about 90 points in the Hang Seng Index, that's 0.6%. The index projected to open at 15,370. And you can get more details on the latest market movements in my daily newsletter at peterlewismoneytalk.substack.com.
Every Monday to Friday, this is Peter Lewis's Money Talk. Peter Lewis's Money Talk.
It's been a busy day for economic data and a chaotic day in the markets, so much to talk about. Let's welcome our regular Thursday morning guest, Andrew Freris, the CEO of Ecognosis Advisory. Morning, Andrew.
Good morning. Good morning.
And also with us is Marc Franklin, who's Managing Director and Senior Portfolio Manager of Multi-Asset Solutions and Manulife Investment Management in Hong Kong. Happy New Year to you, Marc.
Good morning, Peter.
Let's start with some of that China data. Let's first of all talk about the GDP data. The Chinese economy, it expanded 5.2% year on year in the fourth quarter of 2023. That's faster than the 4.9% growth in the third quarter, slightly below economists' forecasts of 5.3%. The quarter-on-quarter growth rates was slower than 1.5% recorded in the third quarter, which was revised upwards. And on a yearly basis, for the full year, the economy grew by 5.2% as well. That exceeds the official target of around 5%. And it also picks up from a 3% rise in 2022 amid various support measures from Beijing and also a low base comparison from the prior year. Marc, let's get your thoughts on the GDP data, first of all. Beat the official target of 5% anyway, but I suspect if you dig deep into the numbers, there's a few worrying signs, aren't there, going forward?
Yes, I think for both domestic and external political consumption, the GDP number was also always going to come in acceptable, and a slight beat also tries to convey the sense that the path ahead is a solid one for the China economy. But as you said, under the hood, retail sales closed the year somewhat weaker than expected. And that's in spite of the fact that at the margin anyway, both monetary and fiscal policy support is starting to crank up. The economy is now fully reopened post-COVID, but there's still a bit of a scar tissue effect for households and businesses who suffered during COVID in terms of depletion of savings, but also a lack of clarity and confidence about the future outlook. And as a result, spending decisions are somewhat more modest than they might have been otherwise. And the other point to make as well is that the real estate sector still struggles along a little bit. We're still seeing price degrowth month over month. And given the proportion of household wealth that's tied up in real estate assets, that has an impact on a sense of well-being and therefore consumer confidence.
And of course, also, you have to take into account that growth is real growth, isn't it? So if you strip out deflation, then you're looking at maybe nominal growth of what, around about 4.2%.
That's correct. I mean, certainly on the PPI side, we've been experiencing a period of deflation. And on the consumer side, inflation is very modest. And one of the reasons for that, to be fair, though, is that in Chinese CPI, food prices are quite an elevated weighting relative to Western economies, and in particular pork and pork-related pricing. And there's been an excess of supply on the market for some time, and so that's been a certain esoteric factor for China. But stripping that aside, yes, China's economy is closer to disinflation territory rather than strong inflationary territory.
Andrew, what are your thoughts if you dig into this data?
That is, I will be looking for the quantity of the growth rather than the actual absolute numbers. And Marc has already pointed and put another my favorite 70 major Chinese cities index of property continues now to be falling for nearly 21 continuous months, falling. So in other words, also overall investment expenditure on the property side also goes down. Okay. And in summary, it is the quality of the growth that matters as opposed to the absolute numbers. And the qualitative, well, no, that's the property sector, okay, which is still in deflation. That I don't think it gives light to it. I don't think that the Chinese in any way cooked their numbers, all right? But the 5.2%, it's very good. But then when you look at, the devil is in the details, basically.
How much do we need to take account the base effects that we're comparing to a year ago? I mean, I've heard some economists say that you really need to take maybe 2% off to account for that. So that means you're only going to get growth of about 3.2%. Is that? Do you think that's a realistic assumption?
Well, it always is. But then real GDP also depends not only just on the gross GDP deflator, but also depends on the components of the gross GDP deflator. So you are right, but I would prefer, rather than confuse my clients, God knows they are confused enough listening to me, particularly when my broadband breaks down, Peter, rather than do the real aspect thing, is to simply point out that in addition to all this, we're having deflation in a number of sectors, and in particular in the CPI numbers, which are effectively consistently below 1, and sometimes even below 0. Okay, and now this might have nothing to do with the GDP growth, but it points out that something's not going well as far as the consumption sector is concerned.
Marc,
consumer sector is concerned.
Marc, how much do we need to take into account the base effect here, and what does that mean for growth going forward into 2024?
Well, I think that if I remember correctly, Q4 GDP growth in 2022 was also pretty strong as well, in spite of people saying that given the sort of the immediate aftermath of COVID, they would have expected to be much lower. So I don't think there is a base effect at play here, because the base effect was strong this time last year. Rolling ahead into 2024, you would expect the conditions in China to be somewhat better than in 2023. And a couple of reasons for that is that the government has announced an expanded fiscal deficit projection for 2024 versus 2023, something in the order of 3%, maybe slightly higher than that. So that's showing that they're willing to loosen the purse strings somewhat, although there still is a need to secure the financing of local governments, and in particular rollover debt and the extension of loans, which enables infrastructure projects to be completed as well. So 2024 should be relatively secure for China, because they've indicated that they will start to apply fiscal stimulus to the economy on a relative basis to last year.
And let me ask you both about the population decline. China's overall population fell by 2.08 million last year. It now stands at 1.4097 billion. Births declined by just over 9 million, but that was outstripped by 11 million deaths. Demographers are forecasting further falls as the population rapidly ages. How big a problem is this? And in particular to President Xi Jinping's target of really trying to get per income capita up. The problem is, before people get richer, they've now got to support a rapidly aging population. I would have thought that this is going to be a problem.
May I jump in, Peter? Can you hear me right now?
Yes, I can hear you.
Okay, well, there are two. One is a very facile answer to that, and that is, as the number of people in China falls and GDP growth continues to be high, then the per capita income is going to increase, which is, I'm sorry, it's a very gruesome way of saying, well, there is a small benefit into a decline in population with an expanding economy. The second point, however, is if you have a pear-shaped population, in other words, you are having more and more, people moving away from the pear shape to a much more inflated triangle, a lot more people are aging. The question is the impact of that on labor productivity and GDP growth via the labor component. And my God, we have been hearing this for Japan for nearly the last 100 years, and it hasn't done any significant damage to the Japanese economy. So I want to take this with a huge pinch of salt, of saying that as people get wealthier, they have fewer babies, and that's the way it goes. And in general, productivity can increase even with a rapidly declining population, and that is through technological progress, a more open economy, greater competition. So demographics are very interesting, but I would simply look at the door and say, next, please.
Marc, what are your thoughts about this decline in the population and its impact on the economy overall?
The only thing I would add is that it's technically disinflationary for the domestic economy. So as we know, China has excess productive capacity domestically, which is why it exports so much of it. And if the population is declining, there are fewer domestic consumers to soak that up. And therefore, structurally, China's inflation path over the next 10 years will be lower than its path of the previous 10 years. And I think that's already reflected in the domestic bond market, both in absolute yield terms, but also the shape of the curve.
And presumably it is going to impact the target to try and get people wealthier, to get their per capita income up and get it higher.
Not necessarily. I mean, to Andrew's point, there's a quantity and there's a quality effect as well. Ultimately, if you look at much like the West, but perhaps not as extreme, wealth is effectively in the sort of the middle upper classes and middle aged and above, and therefore that's not going to go away. The biggest challenge actually China faces in the shorter term is youth unemployment and finding enough jobs for new graduates to enter the workforce. Not that this is by design, but obviously as birth rates fall, then there are fewer demanding new jobs in a few years' time, but ultimately they are the engine room of future economic productive growth. So there are unintended benefits as well as challenges that come as a result of these demographic shifts.
Now, what is interesting there on youth unemployment is the National Bureau of Statistics has resumed the release of youth unemployment data. They suspended it in June when it reached a record peak of 21.3%. They've now started publishing it again, and they say the unemployment rate for the population aged 16 to 24 fell to 14.9%. Now, the problem is that's been narrowed down to exclude students, so we can't really, Mark, can we compare this to the number in June so easily? But we need to see some several months, I suppose, of historic data here. It would have been quite useful if the NBS had published maybe some back data on this. But nevertheless, what do you make of this figure? It's still high, isn't it?
Yes, I think they took their time to work out how to restart the series in a way which was attracting less negative attention, certainly from an international perspective, perhaps if not domestically. I'd link it back to the issue of demographics, because if younger people in China feel that their prospects are uncertain, then they're much less likely to start families and also make big investments such as buying a house and buying a car as well. So if you fix the youth employment situation and get the jobs market going again, that will have knock-on benefits elsewhere.
Andrew, what are your thoughts on that? The overall unemployment rate, it did inch up again to 5.1% in December. It was 5% the previous 3 months. And as we just said, the youth unemployment rate now restarted the data, 14.9%. What's your thoughts?
My concern with Chinese unemployment rates was not that they are cooked or they are recalibrated in order to be better, but based on the unemployment rates on urban situation. In other words, I'm looking at the relatives. In other words, if you tell me is 14 high, and I will tell you in relationship, let's say, to domestic unemployment rates of anything between 2 to 4%, yes, it is very high. But the relativity always goes back to saying, are the urban unemployment rates appropriate, particularly if you have a very large amount of transient population, of the domestic immigrant population, which are not counted. So in other words, there is still quite a lot to be done on what is the true unemployment rate in China. And of course, that leaves, in all probability, a huge chunks of the Chinese economy. That is the agricultural sector, which cannot be simply denied or pushed on the side. So I have much more metaphysical issues here, as opposed to saying, yes, 14 is high or 14 is too low and it is suspicious. I will say, put it in the context of what is available as far as Chinese unemployment rates are concerned, and then what has to play with the relativities, and that makes the comparison before and after the release of the numbers quite tricky.
Okay. Now, the other standout...
I prefer not to spend too much time on that.
Okay, sorry, Andrew. The other standout in the data was the property data. As we've seen for the past few months, almost anything related to property has been pretty disastrous. The property sector, from the official statistics, investment in property development fell 9.6% year on year last year. So that's accelerating now from a 9.5% decline in the previous period. Residential property sales, they were down 6% year on year, increasing from minus 4.3%. China's new home prices, they dropped by 0.4% year on year. I think, Marc, however we look at it, the property sector is a big problem, isn't it? It doesn't matter whether you look at investments, whether you look at home prices or sales, the data still seems to be worsening.
Yeah, there's a reset that's required in terms of property prices in China for simple reasons that the supply-demand picture is significantly out of balance. Supply, you've had excessive production, completion volumes over the years. Demand is now much softer. And so what they need to do is find a way to secure the supply side, make it more rational, which means some consolidation of the sector, allowing very marginal developers to disappear, and larger strategically important developers, if they're undergoing financial duress, secure them. And on the demand side, that's going to take a few more years to get back to where we were, if at all, given, as we've talked about, demographic issues, loss of confidence, economic conditions elsewhere that affect us as well. So we would expect that property prices would continue to grind lower for the foreseeable future. What they're attempting to do is effectively manage that path and make it somewhat gradual, rather than creating a shock effect like we saw during the housing bubble burst in the US in the late 2000s. So I think China's very keen to avoid that type of situation, but they're just trying to effectively extend that period of correction over a longer period of time, so it appears more gradual rather than sudden and shocking.
Andrew, what are your thoughts? This is where a lot of Chinese wealth is held, of course, isn't it? So what are your thoughts on the decline in the property sector, the ongoing decline into 3 years now?
Yeah, for me, I will take two completely opposite points, and they all draw a line and they all converge at a single point that I want to raise. And that is, that helped explain when the Vice Premier pre-announced the data and also said, we're not going to spend our way out of this. In other words, there's going to be no huge fiscal incentives or fiscal initiatives. Effectively, he was saying, we're not going to use money to clear up balance sheets, because anything that goes to, let's say, support the property sector, it has to involve cleaning balance sheets. It has nothing to do with making it cheaper for people to buy their homes or reducing the prices of bricks so it is cheaper to produce houses. Money has to go out to clean balance sheets, and rightly, the Chinese government is not keen to see this happening again. Hence, the property sector, is taken out a kind of a second line, second baseline on what they're suggesting or not suggesting. They're about to do it, and hence potentially our obsessive concern about this should perhaps be toned down for two very simple reasons. The three major banks in China are state banks, so they cannot go bankrupt. China has still got a colossal elbow room into its fiscal deficit. So if something was to genuinely begin to upset them, they could spend their way out of this. And then, as Marc pointed out, we may have to live with falling property prices for a few more years, said he casually. So I rather agree with that approach, this trajectory of the property sector.
Marc, how much should we be concerned about debt here? It was interesting that Premier Li Qiang was saying this wasn't done by increasing stimulus and taking short-term risks, but nevertheless, total social financing rose 16%, 16 percentage points last year. Didn't get an awful lot of GDP growth for that, did we?
Yeah, the credit multiplier has been progressively declining in China for years and years and years. And I think it's because the old economic model, effectively using debt at the local government level to build infrastructure, means that the more infrastructure you build, the less marginal utility it has for economic and productive growth. Coming back to the point around debt sustainability, I think that China's approach has been to have extended levels of debt, whether it's in absolute or multiple terms, in parts of the economy and parts of the system where there's less visibility. certainly from a global economic perspective. And at the central level, the federal balance sheet in China is somewhat more pristine, and that's what they care most about, certainly from an optics point of view. So that hasn't changed very much, and there's still at the margin a lack of willingness to absorb some of the excessive debt levels at the local government level, the provincial level, back onto the central balance sheet. They want to keep that strong, clean, and so on. So systemically, it's becoming more and more skewed and more stretched. But if you look at the federal central government balance sheets, it looks much less problematic. And there's partly an optics game at play here.
Andrew, I know you don't like talking about debt to GDP ratios, but nevertheless, it does rather pay to the sort of the lie that China isn't doing much stimulus. They have done quite a lot of stimulus, haven't they?
Well, yes, and possibly in the wrong sectors and possibly for the wrong reasons. And that's why Chinese policymaking and makers, it has always a study in cautiousness, okay? Because they realized they overdid it during the year 2008 in order to boost up the financial sector of the economy whilst everybody else was on fire. And then I don't think they learned their lesson. It ended up that this was perhaps the wrong way to approach it, and then they got stuck with that. Because, of course, that simply produced more buildings and more building activity backed with debt. And now we are paying the price. So I would have to say yes, and not just because you're the main host of this program, Peter.
Don't worry about me. Marc, let me switch attention to the markets. Emerging markets obviously don't tend to do too well when rate cut expectations are dissipating as they are at the moment. But nevertheless, Chinese equities, Hong Kong equities, doing far, far worse than what emerging markets are doing overall, aren't they?
Yes. One of the things that I would sort of caution at is the precipitous drop in equities that we've seen year to date, people saying that is in any way linked to a perception of how the fundamentals are shifting. I don't think much has changed from a fundamental perspective in Hong Kong or China in the last 4 weeks. What you're seeing, we think, is an ongoing persistent de-risking and reallocation away from Hong Kong, China towards other markets by global asset allocators and regional investors, perhaps in anticipation of further issues around sanctions and entities going on lists of non-investment by the US government, as an example, but also investment committees from a risk management point of view instructing their managers to reduce allocations. And there's obviously been a lot of money that's gone into Hong Kong, China over the last 15 or 20 years, MSCI inclusion, lots of IPOs. And so there's money coming out on a persistent basis. And therefore, it doesn't make much sense to frame this from a fundamental point of view, either in terms of how the economy looks, but also in terms of what valuations look like. They were cheap 6 months ago. They've got cheaper still. This is a case of, a structural shift in investor appetite outside of Hong Kong, China for those types of assets.
Are you seeing any signs that structural shift is over and signs of capitulation here?
No.
So you wouldn't be tempted to look at this and say, well, valuations are looking very compelling. This is a time to really be stepping in. You're not tempted?
First of all, it depends on what your time horizon is. If your time horizon is shorter than 6 months, we would basically say just wait until the evidence, both in terms of price action and the change of the narrative, is more concrete. Longer term than that, the thing to watch for is not valuations and saying we're at trough valuations. It's more to say, is the narrative shifting? Has there been a sea change in the China government's approach towards the private sector, its policy towards, for example, fair competition, and therefore a warming up of overseas investors' appetites to re-engage with Chinese businesses and to reinvest again? That would be the turning point, not whether the PE multiple had got to 4 down from 5, for example.
Andrew, what are your thoughts about the sharp declines here that have continued from the end of last year into the beginning of this year? Obviously, the property sector dragging a lot of the market lower, the mainland properties index at an all-time low, but nevertheless, a whole range of companies are being thrown out of the bathwater with the baby. Meituan, Xiaomi, Alibaba, Tencent. What do you make of this and what's behind it?
Well, I'll tell you what I make of this. I'm going to sound like an economist. I apologize, Mark. I agree with 50% of what you said, and then I disagree with the other 50%. And the other 50% is if there is this risking, can someone explain to me why Taiwan ended the year as the best Asian market, possibly one of the best markets in the world, with 27% in US dollar terms? And my God, Taiwan is very much part of the China play. If they're de-risking out of China and Hong Kong, why the hell they were piling money into Taiwan? I have been now following, of course, very carefully what has happened since the elections, whether something like that may or may not continue. But I don't quite buy the story, that it is just about China, and it is not also a fit of pickness that the investors and their advisors just don't get the Fed right. And we just saw a glazing, beautiful proof that sings happily in my ears that they just done it again. In other words, we have industrial output and retail sales in the United States, and bang, everybody sold off. Why? Well, they are not going to cut interest rates anyway soon, said he weepingly. Okay, well, we have been saying this in the last year. Get it right. You can't outguess the Fed. Get a life and do something else.
Okay, well, Mark, let me ask you about where the alternatives are. If we look at the Bank of America Fund Managers Survey, the latest one for this month, they found that investors have cut the amount of money set aside for Chinese equities by 12 percentage points. It's the lowest net underweight now in more than a year. And Japan and India seem to be the main beneficiaries. Japan was the most popular market in the region, more than a quarter of respondents anticipating their double-digit returns in the next 12 months. I mean, this is part of the issue, isn't it? There are alternatives now to China.
This goes back to my point about money being taken out of China and being invested elsewhere. So if you're a regional Asian investor, either ex-Japan or including Japan, and you have been instructed and you've decided to structurally reduce your allocation to China, you've got to find other markets to invest in within the region if that's your mandate. And that's why, for example, Taiwan was partly a beneficiary. But I agree there's a certain cognitive dissonance there with Andrew that ultimately, if you're concerned about China, and by the way, that also encompasses geopolitical policy, then does Taiwan stand to be immune from that? No, not necessarily. But coming back to India and Japan, I mean, for different reasons, it makes a lot of sense. Japan has had a bit of an epiphany, perhaps under pressure from activist investors, to start to come across on a bottoms-up basis, a bit more shareholder friendly, a bit better corporate governance in terms of cross shareholdings, utilization of balance sheet and so on. So there are bottom-up reasons why Japan is faring quite well. And top-down, Japan is starting to become a bit of a favorite as a destination for FDI, marginal FDI flows, which are not going to China and instead going elsewhere. And coming back to Taiwan, actually, one of the markets that TSMC has been exploring to diversify its footprint has been Japan in terms of semiconductor fabs. So there's been a top-down shift in capital flows towards Japan. Bottom-up, corporates are becoming much better engaged with activist shareholders. And in addition to that as well, you've got ultra-loose monetary policy. So you've got a high degree of stimulus in Japan on a relative basis. Other economies are tightening. As for India, I think the story is, as it has always been, combined with one additional factor. So as it has always been, the secular growth story from demographics, from nominal growth, from strong loan growth, under penetration of banking, et cetera, that continues afoot. And then the thing which has got stronger and become an additional driver of people's investor appetite is the fact that you've had political continuity. So Prime Minister Modi admittedly has his critics, but from a consistency, from a welcoming approach towards foreign investment, he has been a mainstay, and investors, institutional investors, like that continuity, like that certainty and visibility.
Andrew, what could be the catalyst that reverses this trend and starts to get foreign investors interested in the Chinese markets once again and money flowing back in?
unfortunately and pathetically unfortunately, and this sounds completely silly, is for the Fed to final cut interest rates so we can concentrate on something else. Okay, and
Yes.
possibly with the European Union. Okay, I must admit I sound both impatient and intolerant, but grown-up people just not learning for 1 year now and getting upset about one bit of statistics goes up, it's good for cuts. One bit of statistics come down, it's bad for cuts, and the market simply follow it. Come on. So yes, it's as simple as that. I would love for the Fed to say we are cutting on Monday and that's it. And then we can get on with other things in life.
Marc, final word to you. What could be the catalyst that could reverse those trends that you've been talking about there?
Well, I think Andrew's right in that China has found it extremely difficult to operate within this ultra-tight monetary policy cycle by the US Fed. There's been a shortage of dollars as well, which has forced them to effectively sell treasuries to raise dollars. So it would help at the margin, but I go back to the point around a more investor-friendly policy mix. So there's been a domestic political shift towards a model of centralization rather than empowering businesses in the private sector to invest and to innovate. And in addition to that as well, there's been some mixed signaling around regulatory policy. So one example in recent times would be the online gaming sector. So the chief policy architect for gaming policy a few weeks ago announced some draconian measures there. Then he was promptly dismissed after a very aggressive negative share price reaction, and those policy measures were diluted away. And so that creates an uncertainty element. So certainty, a slightly more pro-private sector stance, and a softer tone in terms of China's engagement with the international community. All of those factors would definitely help.
Okay. Well, thank you very much for your thoughts this morning. Plenty going on. That was Marc Franklin, who is Managing Director and Senior Portfolio Manager of Multi-Asset Solutions at Manulife Investment Management in Hong Kong, and Andrew Freris, the CEO of Ecognosis Advisory.
Peter Lewis's Money Talk.
I'm joined now by Ruchir Desai, who is Fund Manager at Asia Frontier Capital. Morning, Ruchir.
Good morning, Peter. Thank you for having me.
You're welcome. So we've talked a few times last year about the Asia Frontier markets. Now that we've reached the end of the year, how was the overall performance?
Well, actually, Asian frontier markets had a fantastic year in 2023. Pretty much all our major markets outperformed, obviously global markets, but also more importantly, Asian emerging markets, which kind of underperformed last year. So, for example, broadly speaking, we had strong performance from markets like Sri Lanka, Pakistan, Kazakhstan, and to some extent Vietnam. But the standout was obviously Iraq, which is in the Middle East, which was, I think the index was up almost 100% in US dollar terms. So it had a very strong year across the board for all our Asian frontier markets. And the key drivers, in my view, were the fact that many central banks in our universe already began cutting interest rates in 2023. So we saw aggressive interest rate cuts from Sri Lanka, from Vietnam, from Kazakhstan as well. And broadly, the economy's bottomed out at the end of 2022, and you had discount valuations. So overall, I think all these factors put together led to very strong performance from our markets last year.
And you mentioned the Iraq fund up almost 100%. Was that expected? I mean, how much has that contributed to the outperformance overall of frontier markets?
Yeah, the Iraq index was up 100%, about 97%, and our Iraq fund was up actually 110% in US dollar terms. And that obviously played an important role in the performance of our AFC Asia Frontier Fund. So I would say about 45% of the returns last year came from our Iraq fund because the exposure to Iraq is via the Iraq fund. But that's only part of the story, because the other half, or almost more than the other half, came from other markets like Kazakhstan, Pakistan, Sri Lanka, Vietnam, and Georgia. So it's pretty broad-based performance across the board. It wasn't just one country or a few companies which drove performance. So that's what's very important and very good to know that we had performance across the board in our markets last year.
So what's the outlook for this year?
The outlook for this year, I'm still positive going into 2024, even though performance for our fund and also for Asian frontier markets were very strong last year. But I think there are a few key points which will help drive performance or help drive momentum even going forward. So I think one is central banks in our universe, because they raised interest rates so aggressively in 2022, they still have a lot of room to cut interest rates in 2024 because inflation is coming off quite significantly across our markets. And more importantly, I think this is helped or supported by the US Fed. I would say not just the US Fed, but global central banks moving to a less hawkish policy. Now, I don't know when the US Fed will cut. Maybe I mean, just overnight markets were expecting that the Fed may not cut in March, but probably later in the year. So it could be in March, June, maybe second half. But broadly speaking, the big picture is that global central bank policies are moving to a less hawkish tone, which I believe is very positive for frontier markets in general, because that was the key headwind in 2022. And second is, you have a very strong earnings recovery in 2024, because last year was kind of soft for earnings, especially in markets like Bangladesh, Pakistan, Sri Lanka, and Vietnam. So you'll see those earnings coming off from a low base this year. That's going to support the recovery as well. And more importantly, valuation is still very discounted. So I think, for example, our AFC Asia Fund trades at its all-time low P ratio of about 6.8 times, despite a strong performance last year. And markets in our universe trade, for example, Pakistan trades at a P of 4.5 times, Sri Lanka about 7.5 times, and even Vietnam on a forward multiple is about 10 times. So despite a strong performance, valuation is very attractive. So you have two key, very important tailwinds like lower interest rates and earnings recovery, which will help these valuations relate further. So I'm quite positive given all these important factors coming together.
I mean, we know that emerging markets are sensitive to US interest rates. Is that even more the case for frontier markets? Are they even more sensitive to interest rates maybe than emerging markets in general?
Well, I think you just take a step back and put in perspective what happened in 2022 with the US Fed being so aggressive. That happened alongside the war in Ukraine. So you had high commodity prices, high inflation, high food costs. Many of these countries like Bangladesh, Pakistan, Sri Lanka, which are net food and fuel importers. Plus, they had some macro imbalances, and also in 2020, so they were hit with not just an aggressive Fed, but also their own macro imbalances. So they had to raise interest rates very aggressively in 2022. But now, with broadly their macroeconomic position stabilizing and the US Fed getting less hawkish, I think it's going to be very positive for our markets. So yes, in general, I would say for our markets especially, I think this will be very positive from a investor sentiment perspective.
Now, we had a lot of economic data out of China yesterday. What is the impact of the China slowdown on frontier markets in Asia? And are there any markets maybe among that portfolio that maybe are less impacted by the slowdown in China?
Well, I mean, the Chinese slowdown has been happening for the last few years, especially over the last probably 18 months or so. But it's not really had an impact on our markets, as you can see with performance. Or last year, very strong across the markets and also for the fund. So I think many of our markets are driven more by domestic investors and domestic sentiment, not so much by foreign capital, and especially not Chinese capital or Chinese investors in equity markets in our universe. So it's a very domestic-driven story. And also, if China's slowdown continues, say, in 2024, I don't see a big impact on most of our universe. For example, many of our countries, especially in South Asia, like Bangladesh, Pakistan, and Sri Lanka, they're not very trade dependent anyway. For example, exports as percent of GDP is less than 15% as a percent of GDP for all these countries. So not very trade dependent, despite what happens, say, for example, slowdown in China or a slowdown in the US, the relative impact on these countries will be less. But of course, Vietnam is very export dependent. Not just China is the biggest trading partner, and the US is the biggest export market. So yes, if for example global trade does see a continued softness in 2024, there could be a risk for Vietnam's export recovery this year as well. But having said that, Vietnam is the key beneficiary in Asia from the global supply chain shift. So you've seen a massive influx of foreign direct investments coming into the manufacturing sector in Vietnam, because many companies are moving their operations from mainland China and other parts of the region into Vietnam. So I'm not so concerned about the long-term growth for exports. Plus, Vietnam has access to many free trade agreements. So yeah, maybe the next 6 months will be soft, but if I take a 3 to 5 year view, I think Vietnam will be a key beneficiary of the global supply chain shift.
And is that likely to get upgraded to emerging market status in the near term?
Well, for emerging markets status, I mean, most investors, global investors, look at the MSCI indexes. And right now, Vietnam is in the MSCI Frontier Markets Index. But Vietnam has to change certain things, like, for example, allowing foreigners to buy certain stocks which are fully foreign-owned, and some other technical issues which they need to resolve, which I don't see happening in the near term. So from a Vietnam getting upgraded to the MSCI Emerging Market Index, I think that'll take some time. I don't have a timeline, but I don't see it happening in this year for sure.
Okay. In other markets, let me ask you about the South Asian markets, in particular Sri Lanka. I mean, that was in the news a lot last year, wasn't it, because of its economic crisis and its debt problems. Has it managed to dig itself out of that hole now?
Yes, I think Sri Lanka had a very tough time in 2022, with high inflation, high interest rates, with the social issues and the political unrest that they had. especially in the middle of 2022. But in my view, Sri Lanka bottomed out at the end of 2022, beginning of 2023. And in fact, we started buying some stock in Sri Lanka at the start of 2023 because we believe valuations have bottomed out. But broadly, from a macroeconomic perspective, they've seen a very strong recovery in very important areas. For example, tourism was a key contributor to foreign exchange revenues pre-pandemic and pre-crisis. And that's come back very strongly. So, for example, in 2023, they achieved almost 1.5 million tourist arrivals, which is almost back to about 70% of pre-pandemic numbers, which is about $2 billion of foreign exchange revenues. And their worker remittances, which had really dipped a lot in 2022, they've come back to about $6 billion. So very strong recovery for two important drivers of their foreign exchange reserves, which have come back very strongly. And I think this trend will continue going forward as well. And they should be able to get back to the full recovery for tourism and also remittances by end of 2024. But broadly, on the external side, that's really helped them a lot. But also domestically, for example, they've got the IMF program in place. They've done all the tough reforms over the last probably 12 months. They've also got the domestic debt restructuring carried out for the local banks, and so they're almost through. They just have to complete their external debt restructuring with the sovereign debt holders. That's almost done. I would say probably next couple of months. So in fact, they've crossed the hurdle, and now they are. I would say they're in a good position to go back to their historical trend growth of about 4 to 5% GDP growth.
And what about those other two South Asian markets, Pakistan and Bangladesh? How are they looking?
Well, actually, Pakistan is a pretty interesting story. So despite what's happening, despite all the negative news flow in Pakistan over the last probably 18 odd months with political crisis, the economic crisis and high inflation, etc., Pakistan between June 2023 and December 23, in the second half of 23, they were the best performing market globally in US dollar terms. It's a very strong recovery. And there are a couple of reasons for that. One is obviously, like many other markets, local investors expect that interest rates will start coming down from 2024 because inflation has peaked out. And secondly, of course, more importantly, also the IMF program is in place for Pakistan, and they would most likely sign a new IMF program in March or April of this year. And third point is investors expect greater political stability going forward because the elections are coming up at the beginning of next month. And that would probably, bring back policy making and, a business-friendly government. So investors really appreciate that. And the market is so cheap. And, like I said, the P multiple for Pakistan is 4.5 times. And it's the lowest multiple since probably 2009 after the global financial crisis. So I think it's still long. I would say Pakistan is a market which can still outperform in 2024. And coming to Bangladesh, I think over there also some important developments have happened. The elections just took place, I would say, about 10 days ago. So obviously the previous government has come back to power, and that again will probably bring some momentum back into policy making, some better investor sentiment, business sentiment should see an improvement. So I'm quite positive for Bangladesh, especially going into the second half of 2024, because they still have to do some macro adjustments in terms of currency and interest rates, given the macro headwinds they faced last year. But looking beyond the first half of 2024, I think Bangladesh also can start recovering going forward as well.
How do you invest in these markets? How do you find investable stocks, investable instruments? Because there's not a lot of them around, are there?
Actually, that's a bit of a misconception about frontier markets, that they're not liquid or not too many companies. Frontier markets actually, especially Asian frontier markets, the larger ones, are quite liquid compared to some of the other frontier markets, say in Africa or Latin America or Eastern Europe. For example, Vietnam's daily turnover is, at the peak was about $1 billion a day. Now it's about $700 to $800 million a day. That's very large. That's higher than even the Philippines or Singapore. And even countries like Pakistan, Bangladesh, Sri Lanka, their volumes are still pretty healthy, despite the misconception that they're not very liquid. They may not be as liquid as, say, in India or China, but they're more liquid than the other frontier markets, like I mentioned. And as I mentioned, domestic investor sentiment is improving, so liquidity has seen a significant improvement over the last 6 or 9 months. And just from a stock selection perspective, there are quite a few listed companies, especially blue chip companies, which one can invest in. For example, Vietnam has across 3 exchanges about 1,000 listings. Pakistan has about 300 listings, same for Bangladesh, and probably 200 listings for Sri Lanka. From there, of course, we select certain stocks based on our criteria. But for example, at any point in time, we could easily look at, just from an investor perspective, we could easily look at across all these 4 markets about 100 names. So there's a large universe out there.
So hearing you speak in summary, I mean, it's looking very good, isn't it, for this year, for pretty well any Asian frontier market. They're all looking pretty attractive and pretty compelling.
Yeah, I would say they're looking quite compelling. And like I mentioned, I think the valuations are still very attractive. Most markets in the universe trade at 10 times or less. You have the key, very important headwinds which are becoming tailwinds now in terms of lower interest rates, lower inflation. Plus, you have earnings recovery, and more importantly, I think you have global central bank policies moving to a less hawkish stance. So I think that's going to help investor sentiment in domestic markets as well, and that could possibly lead to a lot of foreign inflows coming back into these markets, and that could really drive the market even further in 2024.
Well, Ruchir, thank you very much for telling us about that.
Thank you for having me.
That's Ruchir Desai, who is fund manager at Asia Frontier Capital.
You're listening to Peter Lewis's Money Talk.
Money Talk.
Thank you for listening to Money Talk this morning. You can find more business and finance information from around Asia in my daily newsletter, which is at peterlewismoneytalk.substack.com. On tomorrow's programme, I'm joined by Francis Lun, the CEO of Geo Securities, and Lashar, Asia Chief Economist at BBVA. And with a view from Australia is Toby Lawson, CEO of Staten Partners. Have a great day.
Money Talk.